forex.com playbook. The 10-hour moving average has just crossed decisively above the 6. What if the very indicators that made you a consistently profitable trader back in 2020 are the exact same tools that will completely liquidate your account today, right now in 2026?
They absolutely will.
Right. So we're doing something a little different today. If you have your platform open and you are looking at the live XAUUSD chart with us right now, I mean, the volatility is just breathtaking.
It's insane.
We are bypassing all the standard pleasantries today. The mission of this deep dive stream is to take this massive stack of 2026 institutional forecasts, broker guides from Think Markets and Axie, technical analysis manuals, psychological playbooks, and apply them directly to the live price action happening on our screens this very second.
Exactly. Keep your finger on the trigger.
Yeah, we aren't here to shout out guaranteed profits because, well, as our sources make very clear, those do not exist. We are here to find exactly where the mathematical and statistical edges actually lie in this hyper-aggressive market so you can lock in those high-probability trades.
The urgency of understanding these mechanics right now, I mean, it really cannot be overstated. What you are witnessing on the screen is gold behaving fundamentally like a risk asset.
Yeah, it's wild.
The 2026 market dynamics have completely shifted the landscape. We are seeing massive, violent price swings. And if you aren't dialed into the exact mechanics of what is driving this underlying volatility, the market algorithms will simply run you over.
Okay, let's unpack this immediately because, wait, look at the 5-minute chart right now. We just got a sudden massive volume spike.
Yep, there it
A
is.
huge green candle is forming, and the market is suddenly moving at lightning speed. It's like someone just flipped a switch on the global liquidity.
Well, they essentially did flip a switch. It's the clock.
Right.
What's fascinating here is that we are right in the middle of what institutional traders call the NY-LON overlap. That is that critical 4-hour window between 8 a.m. and 12:00 p.m. Eastern.
The absolute peak.
Exactly. The DefCox and Think Markets sources both highlight this as the absolute peak of global market liquidity. This is when the London session and the New York session are fully open at the exact same time.
So you have European traders reacting to their afternoon data and U.S. institutional traders flooding in for the morning open.
You got it. And in 2026, gold's average daily range, its ADR, is sitting at an absolutely staggering 200 to 300 pips.
Wow.
During this specific window, you can regularly see intraday spikes of $150 to $200.
It's essentially a financial super collider. You've got these two massive continental markets smashing their order books together at high speed, creating all this kinetic energy.
That's a great way to put it.
But here is the critical question for you and me. If the market is whipsawing 300 pips a day, how do we not get immediately wiped out by all this market noise? Because, I mean, in the old days, you just set a 20-pip stop loss and call it a day.
Which is exactly how you drain your account today.
Right.
This is where you have to implement the average true range, the ATR indicator, immediately. The Headway technical manual is adamant about this. Standard fixed pip stop losses, like that rigid 20-pip safety net you just mentioned, they are completely obsolete in 2026 gold trading.
Because they just get hunted.
Well, they will trigger prematurely on pure, meaningless market noise. You need a dynamic stop loss. The ATR doesn't care about your feelings. It calculates the actual mathematical volatility of the asset in real time over a set period.
I love that concept. It's the difference between driving a rigid go-kart over a Rocky Mountain road versus driving a luxury SUV with a dynamic air suspension system.
Exactly.
The fixed stop loss is the go-kart. Every single bump throws you completely out of the seat. The ATR is that dynamic shock absorber. It expands and contracts based on how rocky the terrain is at that exact second.
That is a perfect analogy, and the math behind it is what saves you. The ATR measures the true range of recent candles, factoring in any gaps in price.
So how do we set it right now?
If you are entering a trade right now, the Headway guide suggests setting your stop loss at exactly 1.5 to 2 times the current ATR value.
Okay, got it.
If the ATR is reading high because the market is frantic, your stop loss mathematically widens to give your trade the exact breathing room it needs to survive the whipsaws.
Makes sense.
And if the market calms down, the ATR shrinks and your stop loss tightens, protecting your capital from a total structural reversal.
Wait, hold that thought shifting over to the 1-minute chart.
Okay, looking.
We have a massive red candle dropping right now. The price is just crashing toward a key psychological level.
Yeah.
Now, checking the relative strength index, the RSI, it just hit 30.
Careful here.
Normally, standard textbook rules drilled into every retail trader say 30 is oversold, which means we should look for a buy entry right here. But looking at the headway manual we brought today, they argue that in 2026, a 70-30 RSI setting is basically a death trap. Why is that?
It is a death trap because high momentum markets will just peg the indicator.
Right.
The RSI is an oscillator, right? It measures the speed and change of price movements on a scale of 0 to 100. Retail traders are taught that when it drops below 30, sellers are exhausted.
Which seems logical.
It does, but in this current algorithmic environment, gold trends so aggressively that it can stay at an RSI of 30 for hours while the price continues to plummet another $50.
Oh, wow. So you just keep trying to catch a falling knife.
Exactly. You must adjust your RSI parameters to 80/20 for XAUUSD. You are waiting for absolute, undeniable mathematical exhaustion.
But let me push back on that for a second. If we wait for an 80 or 20 extreme, doesn't that mean we miss out on like 90% of the daily trading opportunities? Is that trade-off in volume really worth the safety?
It absolutely is, because volume without probability is just gambling.
Good point.
You aren't trying to catch every ripple in the ocean, you are trying to catch the